All of the details we provide is actual client data with only the client names changed. While the client assumptions and the projected outcomes at a 20-year mark are shown, as well as the starting data, the actual work product with annual details cannot be shared until such time as we're engaged for services. In case study number 2, we changed our client names to Eric and Jane. In this particular example, we are able to propose a tax savings of over $1 million and increase their net wealth at 20 years by over $3 million. Eric is a retired engineer, and his wife spent most of her life as a homemaker. They have accumulated a fair amount of assets, which are displayed on the screen. Eric is age 66, and Jane is age 61. And they've been our clients since early 2008, before the crash occurred. At that time, their total investments were about $2 million, and they've done quite well between then and now. Even though he came in with just $2 million before the crash, they have over $5.4 million at this time with us. Eric gets a pension of $112,000 a year, which is not inflation adjusted. Jane started receiving Social Security at age 62 in March of 2019, just shy of $11,000 a year. Eric started a spousal restricted benefit when he turned 66 in April of 2019. It's a small benefit of $605 a month. When we use a 2.5% inflation rate on the Social Security with deferral credits, by the time he's age 70 in 2023, his Social Security is expected to be nearly $41,000. Their earnings forecast that they chose to use is 8% on IRAs and 6% on taxable. That 8% tends to be a little assertive for us, but since we've earned double digits for this client since he came on board, we're okay using those numbers. And at the end of the day, it's the client's choice what earnings rate we use anyhow. They feel comfortable using a 3.5% inflation rate on lifestyle and 6.5% inflation rate on medical. The lifestyle need is $125,000, which is all inclusive of everything except for health care. That's listed at $15,000 until the spouse turns age 65 and then reduces down to $12,500 when they're both on Medicare at that time. For them, the 20-year expected income taxes on the current plan was over $3 million. And using our proposed plan, we were estimated to be able to get that down to $1.9 million, a savings of over $1 million in taxes. We have a pretty assertive tax plan in place in order to do that. And for the record, there was 4 differing tax scenarios that we looked at for this couple. This proposed plan being the one that they opted to do. At the end of the 20 years again, we're not completely eliminating the IRAs, but we're reducing them substantially by over $6 million. And at the end of 20 years, we are proposing to be able to increase gross wealth by over $1 million and net wealth by over $3 million. We anticipate having almost $13 million in the Roth IRAs by sacrificing the IRA assets of $6 million and reducing the taxable account by $5.5 million. At the end of the 20-year proposed plan, gross wealth is expected to increase again by $1.3 million and net wealth by over $3 million, which is a more than 20% increase in net wealth. So here's the measuring sticks that we like to use. After 20 years of expected sacrificed wealth in the taxable account is $5.5 million, and the sacrificed wealth in the IRA is $6 million. So the total sacrificed in those 2 less tax-efficient accounts on a gross basis is $11.6 million. But the expected outcome is a gain in the Roth account by almost $13 million. That means that the gain in the Roth is 11.5% more on a gross basis than the sacrificed assets in those 2 less tax-efficient accounts. So a rhetorical question that I'd like to ask is, would you reposition your assets if you knew the IRS would pay you 11.5% to do so? That means you'd be getting paid 11.5% to prepay the mortgage in your IRA account. If we do the same analysis on a net basis, meaning in this couple's case using the assumption that 68% of the IRA belongs to them and 32% belongs to the IRS, that's because they're in a higher tax bracket, as are their children. Therefore, with this assumption, the sacrificed value of the IRA portion that belonged to the client was only $4 million rather than the $6 million. That means the gain in the Roth IRA would represent a 33.9% over and above the sacrificed wealth of the net wealth in the IRA and the wealth in the taxable account. So would you do that if that was proposed to you? And then if you were the heirs, would you rather inherit what's reflected here as column A, or would you rather inherit column B? If you were the heirs and you were able to stretch these accounts and accumulate them over a 45-year distribution period, here's the expected value on the screen of the stretch for the heirs. But a tax-free Roth account provides complete financial freedom, which is why we call it the Advanced Financial Freedom Plan. You need to understand that you can take as much out of the Roth anytime you want to without any concern of taxation. You can purchase a $1 million chalet in France and not pay any taxes on the Roth distribution to buy it. Or you can buy a condo in Vegas or a Lamborghini out of the account and have zero tax consequences. Can you imagine having to take $150,000 out of your IRA because you wanted to buy a condo as a second home, and then having a $60,000 or $70,000 tax bill next April, effectively increasing the cost of what it is you wanted to buy by 40%? Versus if it's in the Roth account and you take the money out tax-free. Or imagine if your child or grandchild got in trouble and you needed to take $50,000, $75,000, or $100,000 out of your IRA, and then have the tax bill that came with that the next year to help your child out, versus it being a Roth IRA and you just take it out of the Roth. You have the financial freedom to do that without worry of taxation. If you want to help your grandchild with college expenses, you get the point. Again, that's exactly why we call it the Advanced Financial Freedom Plan, using advanced tax strategies to gain financial freedom for you. We'd be happy to discuss this and the value of the stretch laws in the free consultation on the phone that we offer with you. Please schedule a call with the tax planners now and let us discover ways to maximize your net wealth through our strategic tax planning. With our money-back guarantee, what do you have to lose? Start your Advanced Financial Freedom Plan with us today. I'll close this presentation with a few myths. Myth number 1, taxes do not have a dramatic impact on your wealth. Well, I could assure you and demonstrate to you that they do. Myth number 2, there is nothing I can do about income taxes. That's a complete myth. Absolutely, positively, there is something you can do about income taxes. Myth number 3, I'll be in a lower tax bracket in retirement. That is a myth for most of the people that we meet. Not most of those people are in a lower tax bracket. Some of them are in a higher tax bracket because of the double taxation that I talked about earlier. And myth number 4, save in your 401k. Well, actually, I want to encourage you to teach your children that might want to save in their 401k. But they want to have an Advanced Financial Freedom Plan when they start hitting their mid to late 50s so that when they get to retirement, they can learn how to turn the table on the IRS before it's too late. So please give us a call and let us help you discover ways that we can help you with your planning, more specifically your tax planning, today. Thank you.